Good morning and welcome to Charting the Markets on Tuesday, the 2nd of May. Yesterday, many financial markets, not just in the UK, but also in Europe and further afield, were shut for the May Labour Day. And what also happened is that the US bank JP Morgan bought the struggling First Republic Bank. And this means that we've now seen a third US bank falter in the past couple of months. So this came after Silicon Valley Bank and also Signature Bank having to be bailed out. But the difference this time around is that all deposits were guaranteed or basically taken over by JP Morgan, which meant that the US government did not have to declare the bank a systemic risk to protect deposits over the $250,000 guarantee limit. What we also saw overnight is a surprise rate hike by the Reserve Bank of Australia, which hiked its rates by 25 basis points to 3.85% as it tries to lower its stubbornly high inflation in Australia, which is still reading at the moment at 7% year on year. And it basically also said, the central bank that is, that it may have to tighten rates further in order to bring that inflation rate down. What we also saw earlier today at 10 a.m. UK time was Eurozone inflation, which came in at, as an expected, 7% with regards to flash CPI data there, and core inflation coming in at 5.6%. So that was as expected. And later on today, we have the earnings out for Pfizer, Ford, Uber, and AMD. So let's see what the takeover by JP Morgan of the First Republic Bank basically has done to the FTSE 100's share price. And as we can see on the daily financial bet, there was some risk-on sentiment, which puts the FTSE 100 earlier this morning on track to reach its April high at 7,938. But then we saw some profit taking coming in short term. So you can see here very little trading going on, very little volatility at the moment. But we remain above the March to May uptrend line, which currently should act as pretty good support around the 7,830 mark. And from a technical perspective, provided we stay above last week's low at 7,788 on this daily financial bet on a daily chart closing basis, we should see further upside, and a rise above the high seen in April at 7,938 would put the psychological 8,000 mark back on the cards. Now, in Germany, what we've seen here is also a brief 13-month high, I believe, this morning at 16,009, which took us back to levels last seen in January of 2022. So actually more than 13-month high, before the DAX started to slightly retrace lower. So here we are currently consolidating below the psychological 16,000 mark ahead of Thursday's European Central Bank meeting, where we expect rates to be hiked by 25 basis points, basically meaning that the deposit facility rate will rise to 3.25% if that is the case, and the main refinancing rate to 3.75%, and the marginal lending rate to 4%. So it's not surprising that we're seeing a short-term pullback here in the DAX 40 daily financial bet. But again, from a technical perspective, provided we stay below the last reaction low, that is to say a low below the previous candles and the following candle, as we saw on Friday at this 15,694 low, provided we stay above there on a daily chart closing basis, further upside is likely to be seen, and a rise above today's high at 16,009, if we go onto a weekly chart, would then take us back up again towards the November 2021 to January 2022 resistance line, which currently can be seen at 16,180. So that's our next upside target for the DAX 40 contract, which ended up the month of April on a positive footing. So yes, upside momentum is slightly on the wane, but basically we are still seeing further upside. And as I said, provided we stay above 15,694, I expect further upside to be seen with regards to the DAX 40. Now, the S&P 500 is also kind of interesting because here we rallied back towards the February high and nearly reached it on Monday, yesterday, 4,187 on this daily financial bet, and came very close to the highs seen back in February at 4,195, ahead of tomorrow's FOMC meeting, and in which we also expect a 25 basis point rate hike to take the Fed funds rates to between 5 and 5.25%. So this resistance short-term might really cap the market between 4,187 and 4,195, and perhaps lead to a retracement back to the early April high to be seen at 4,141. But again, from a technical perspective, provided we stay above the last reaction low, that is to say last week's low at 4,050, and above this uptrend line, which can be drawn from the March to April lows, further upside is more likely than downside. And if we were to rise above 4,195 on a daily chart closing basis, as you can see here, we would then be forming a medium-term to long-term bottoming formation. And it would really probably not just lead to a rise to above the August 2022 high at 4,325 being seen, but could actually mean that the long-term uptrend, which goes back to several years, is actually resuming. So it could be a very, very positive sign for the S&P 500 if we were to rise and close, ideally on a daily and weekly closing basis in the next few weeks above this February high at 4,195. The US dollar has been relatively volatile of late, and obviously ahead of Wednesday's Federal Open Market Committee in the US, where we expect a 25 basis point rate hike to take the Fed funds rates to between 5 and 5.25%, and also ahead of Thursday's ECB meeting, where we also expect a 25 basis point rate hike. You can imagine that euro dollar is going to be quite volatile, and at the moment what we're seeing here is a very slight, slowly descending euro dollar, and we seem to be on track for 4 consecutive days of lower readings with regards to this exchange rate, having reached an over 1 year high just last week at 110.95, and now basically fallen through the psychological 110 area. We are heading closely to the late March high at 109.29. Now, if we were to fall through the mid-April low at 109.09 here, then it is possible that a top is being formed, and that could be the case with regards to these anticipated rate hikes that I've just mentioned with regards to the Fed on Wednesday and the ECB on Thursday. So we'll have to see whether 109.09 will be taken out or not. If so, I expect us to slide to the 108.32 10th of April low and the 108.04 mid-February high. So that would be the next downside target for euro dollar. If, however, the rate hikes do not happen, or if forward guidance is different to what we expect the central banks to come out with, both in the US and in Europe, perhaps we could then see a rise above the 110.95 level, that is to say the April high, take shape. And if so, we would then be heading up again, as you can see here on the weekly chart, to the red line here, the 200-day simple move, 200-week simple moving average at 111.95. So that would be our next upside target, together with the March of 2022 high at 111.85. And slightly above there, we have the 61.8 Fibonacci retracement of the entire 2021 to 2022 decline, which comes in at 111.74, I believe. So perhaps that is another possibility, but we'll have to really watch these short-term support and resistance levels closely with regards to the ensuing trend. So on the one side, 109.09 for the short-term topping phase, because a slide through there would be toppish, and on the other side, 110.95, because a rise above there would probably take us to 111.85 or so. Now, let's have a look at the Japanese yen versus US dollar, because that has been very interesting of late. As you can see here, we had an explosion to the upside following comments last week by the newly appointed governor of the Bank of Japan, Kazuo Ueda, in which he modified the central bank's forward guidance by removing references to COVID-19 and vowed to keep interest rates at current or lower levels. And that has led to the weakening, a very strong weakening of the Japanese yen. And as you can see here, the inverse dollar yen rallying all the way above the red line here, the 200-day simple moving average at 136.96, and basically led us to earlier this morning nearly retest the March high at 137.91. So this is kind of interesting because together with the high seen back in December at 138.17, it is acting as the last resistance area before a major medium to long-term bottom can be formed. If we were to close on a weekly closing basis above 138.17, I wouldn't be surprised if the exchange rate were to be heading back up again towards the November highs, that is to say the late November highs at 142.25 and perhaps even the 145 area. But it is really, really important resistance, so perhaps it may just cap. And once again, we may then slide back again on the back of a generally weaker US dollar. So an interesting chart to watch out for in the next few days. Also, another interesting one is the Australian dollar versus the US dollar, because here what we saw is earlier today, as I mentioned before, the Reserve Bank of Australia basically surprising market participants by hiking its interest rates by 25 basis points and taking the interest rate in Australia to 3.85%. The central bank also said that it may have to tighten its monetary policy further in order to reduce stubbornly high inflation, which currently still sits at 7% year on year in Australia. So on the back of that unexpected rate hike, we have seen a rally in the Aussie dollar versus the US dollar, taking us close to the February to May downtrend line at 67.23, and also the red line here, the 200-day simple moving average at 67.34. So this resistance area would need to be taken out for us to retest the April high at 68.06. So far, we seem to be struggling around that area, and we may be capped there, and we'll have to see whether that is the case in the course of this week, and if so, whether we would then fall back through the April low at 65.74, because in that case, as you can see here, if I zoom out a bit, we have a lot of possible downside targets, the first being the 10th of November low at 63.86, which could be hit on a potential fall through 65.74. Now, what is interesting is also the price of crude oil. If you look at Brent crude oil, what we've seen last week is a closure of this March to April price gap, and then the price of crude oil slipping much further and hitting a 1 month low at $77.36 on prospects of further rate hikes being seen, lingering recession fears, and uncertain demand out of top producer China. And short term, we had a minor bounce back last week, but we basically stayed below this 1 month downtrend line, which currently can be seen around the $80.20 mark. And also, as long as we stay below the last reaction high, that is to see last Friday's high at $80.49, further downside is likely to take shape. And a fall through this low, which was made in April at 77.36 in late April, that is marginally below the January low, would then take us back to the December low at $75.32. So that is the most likely scenario with regards to the price of crude oil. With regards to the price of gold, what is happening here is that we are now entering the third consecutive week of low volatility sideways trading. On the one hand, between 1,970, the mid-March April low, and on the other hand, this 2006 to 2012 dollar resistance area. So that needs to be watched out closely, because if we were to rise above $2012, The April high at $2,048 per troy ounce is likely to be retested. However, if we were to slide through and close on a daily chart closing basis below the mid-April low at $1,970, it is likely that not just the February high at $1,959 would be reached, but also the 1,944 to 34 area, which is made up of late March lows here. You can see on the daily financial bed. So interesting to see in which direction the price of gold will break out of. But right now we're still trading in a tight sideways trading range. Now today I'd like to finish up on a quick look at copper, because the price of copper has been sideways trading quite interestingly over the last couple of months or so. And basically every time we hit the sort of $9,100 or $9,200 per ton level, we would fail and come back down again. And as you can see here, last week we dipped down to $8,428, and that was a level last seen back in January of this year, and marginally below the $8,443 mark, the low seen back in March. And from there, we're currently bouncing back. So it's possible that once again, we will see some upside momentum take us back towards the psychological 9,000 to 9,200 mark. And we'll have to then see whether we could take this resistance area out. So basically what we need to see from a medium-term perspective for the bulls to be back in control longer term would be a rise above the late February high here at $9,212. So that is one scenario as long as 8,428 holds on the downside. If, however, we were to see a slide through there, then the red line here, the 200-day simple moving average at 8,321 would be reached, and probably also the January low $8,189. But right now, it looks more likely that we are going to see a further bounce and increase in the price of copper. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.